Alright guys, welcome back. Sorry for the slight delay. You just had CAD unemployment data come out, which has caused a little bit of a sort of jitter in the markets. I'll be honest, I didn't expect too much from this at all. It just caused a little flick up and down. For the CAD, I think this has probably given us a little bit of a move.
It's a big miss.
Yeah, real big miss. So, CAD perspective, this has been, that's a pretty massive move. Well, 50 ticks down in the CAD, that would have been an extremely fast move, but quite useful that you've actually just broken this little low. And that's perhaps the reason for that size of move. You can see CAD coming off, and you've got multiple lows just here anyway, just broken through them, so that bad number has probably been accentuated by the technical setup to this. If it was to the upside, back up into this range, how big a deal would that be? But something to note going into Bank of Canada in a few weeks' time, that their most recent bit of data was pretty poor. This has influenced their rate decision in the past, but extremely good piece of data beforehand ended up pricing in a rate hike. So we'll talk about that. I'll show you a nice example of that. It was December's Bank of Canada, I believe. Right, bonds. Last bit of fundamental stuff just to get your head around, and probably the trickiest one in terms of a few little concepts. So we'll go through with the help of Victor. He's going to take over and do it all. No, it's okay, don't worry. Right, so money markets first. This is not an area that you are, one, likely to trade, or two, is going to influence your trading too much. The only time it really will is when you get sort of tightening in money markets. And what I mean by this is banks will not lend to each other. That's the predominant part of the money markets. Essentially, it's lending money. So it's interest rate hedging, pretty much. It's anything really less than a year. In practice, it's more like anything lent for less than 90 days and often more like 30 days. So very, very short term. What this concerns itself with is treasury bills, commercial paper, certificates of deposits, Fed's funds, and interbank lending. We'll talk about interbank lending when we do central banks in a little bit more detail. But the idea of interbank lending is that at the end of each day, each bank is going to need certain funding for the next day, i.e. they've got depositors wanting to withdraw money, they've got people wanting to borrow money, so they're going to need to make sure they've got the right balances. Other banks may have had a large deposit throughout that day, so they've got excess, they can lend it out. This is the lending that's done at the bank rate, so the rate that the Bank of England will set, or whichever central bank it is. So not massively important until you get banks not wanting to lend the money out that they have. They may see it as a big credit risk to lend the money out. They may fear not getting the money back. And so as the banks hoard money, someone who needs it then has to pay a higher and higher interest rate in order to get that money lent to them. Makes a fair bit of sense. If you know someone's not likely to pay you back, you're going to want at least a bit of interest from them in the meantime. So not something that is a major issue. The whole point of it, like I say, is cash flow management. Your overnight repos are between a central bank and a commercial bank. So the idea of an overnight repo is that the commercial bank will sell treasuries to the central bank in exchange for cash. So perhaps they need extra liquidity for a short period, with the promise that this will then get switched back, generally overnight the next day. Or it will even be bank-to-bank lending as well. They could do the same thing. So it's collateralized lending, effectively. You will give up something that can't be sold quite so easily, i.e. government bond, for cash that you need short term. knowing that perhaps tomorrow you're going to get that extra cash in, you pay it back, you'll pay a very small amount of interest on that, 0.5%. But 0.5% on $1 billion overnight is still a reasonable chunk of money. So we've gone through why that's reasonably important. At the moment, it's not something that's really too much of an issue, but that's the area that gets influenced when you get interest rates changing, and this changes banks' funding throughout the year, changes banks' cost of credit, and that then gets knocked onto society as a whole. So that's money markets. Bits that we're predominantly focused on are bond markets, which are for much longer term borrowing, basically anything from 2 years onwards, and almost anything you'll trade is going to be from a 2 year up. 2 year bonds generally have reasonably tight ranges, reasonably slow moving. You move up towards a 10 and a 30 year bond because of the uncertainty inherent in whether you'll get your money back in 10 years, in 30 years. These bonds are that much more volatile. Government bonds are slightly different from corporate, so you get obviously two types of bonds, you government bonds, corporate bonds. Now a government bond is an auctioned bond, so the government will auction these bonds to a primary dealer. Primary dealers are in the US a specific panel of banks. In Europe, in the UK, it's generally commercial banks or a certain number of banks that are part of the sort of panel, if you will, so are allowed to participate in these government auctions. The way they differ from a corporate bond is a corporate bond is syndicated. Now what that means is that a bit like when a company sells shares, they will go to a bank, the bank will say, okay, we'll guarantee you your 2 billion borrowing. They will then shop it around and then sell it at whatever rate they can get for it, i.e. that sort of shopping it around and research within their clients will tell the corporation what interest rate they're going to have to pay on that bond based on people's demand for the bond. The higher the demand, the lower the interest rate. The lower the demand, the higher the interest rate. Once the primary dealers have got them, they've got two choices. They can either use them, as in hold on to them, and use them in their money market lending, so use them as collateral. And that again is where you'll get hoarding of bonds or banks' desire to actually buy bonds. Because we had some issues at the end of 2016 in European money markets, you got a lot of buying of German Schatz, despite the fact that their yield was minus 0.8%. Reason was, Schatz is a very safe place to have your money. German 2-year debt. Unless you can see Germany going bust in 2 years, it's a pretty good shout. So people still wanted that because they could use the Schatz in their money market operations, so to sell to the ECB in order to bring money in. It's to do with a liquidity crunch going into the end of 2016 as well. So banks needed extra cash, so they would be happy to own negative yielding bonds despite the negative yield, just so they could use them for a repo situation. There's a lot of noise going on. I'm kind of intrigued what's going on. S&P rallying, CAD dropping. I think it's probably a bit of a CAD trade.
CAD actually pulled back the whole thing, unfortunately.
Wowzers.
Yeah.
Well, yeah, that's why people are angry then. I can understand that. So yeah, that's what happens with the bonds. They're either then sold or they're lent out by these primary dealers. So what we'll do, we're going to have a look in a second. I will attempt to explain government bond auctions to you guys, the salient points, the bits that you're expecting to see, and also what you're likely to get in terms of market action, because it's all well and good understanding it. Knowing the implications for the market is what's the most important part. So, let's go one more. Before we actually look at auctions, I'm pretty sure most of you probably know this, but in general, well, not in general, it's a fact, the way bonds are priced, the way bonds are worked, they're all sold at a par value. So your par value might be $1,000. You get a maturity and you get a fixed coupon. This is with a government bond. When you have a corporate bond, this varies a little bit. Obviously the maturity won't vary and the par value, but the coupon comes from the syndication process and the finding out what people are willing to bid for it. That's why they're called fixed income though. So for example, you got a £1,000 bond, $1,000 bond, 5-year maturity and a 4% coupon. Therefore you're going to get $40 a year in interest on this. The yield comes from the current price of the bond. So if the bond falls in price, the yield effectively rises, because you could buy the bond for less money and still get $40 a year, because the amount of interest is based on the par value of that bond. Therefore, drops to 800 and you're now getting 5%, it drops to 200 and you're getting 20% in terms of yield. You're not often going to get bonds with this type of yield, but I've got a nice chart in a little bit of Greek bond yields in 2010 maybe, once the debt crisis was going, and you look back now and you're like, why didn't I buy some Greek bonds? The ECB was never going to let them go bust, and you could get something crazy like 50% a year interest on Greek 2-year bonds. So unless they went bust in the next 2 years, you're going to make 50% on your money. Make sure you track yield charts as well. Yield charts are very, very important, because futures take into account various different bonds, i.e. a Bund future is priced on what is known as the cheapest to deliver bond. So that is any 10-year bond that you can buy that meets the criteria. So for a Bund future, it needs to be a 10-year bond, basically. You can buy any of those. So you could buy one that is perhaps only got a year to maturity, but if that's the cheapest bond out there, that fulfills the criteria of the futures contract. So futures contracts aren't always entirely aligned with yield. Roughly they are, but not entirely. So keep your eyes on yield charts. You know, if you get a big yield level, and I'm not someone who is an advocate of what people call psychological levels, as in $100 for something, or if the S&P hits 2,500, people say, oh yeah, you should buy it. It's a psychological level. To me, it's not. It's a round number. I don't see why that's any more important than any other number. But with yields, it does seem to have a little bit of impact. So 1% yields, 1.5% yields do seem often to create a little bit of reaction. So keep your eyes on those yield levels. At the moment, UK yields are around about 1.5%. Bund yields are around about 0.4, 0.5%. So stay reasonably aware of them. Certainly, if you're getting large moves, like we've kind of seen in Bunds recently, check those yield levels. Be aware of where those next levels are coming in. If we break out of a big range, which is what we got in Bund yields not all that long ago, we broke out, and that was part of the reason for this big sell-off in Bunds. I'll get you that up just a sec. A 10-year and a 5-year just there. It's going to crash on me now. There you go. So that's what we had for most of last year, effectively a bund in a range between 0.5 and 0.15%. This breakout came basically at the beginning of the year. As soon as we got a break of this range, that's when we really started that sell-off in bunds. So being aware of what the yields are doing gives you a pretty good clue as to what's going on, and can give you a little sign that, you know, once we'd got effectively the gap up at the beginning of the year, this was always on to go higher because we gapped out of this old range. You got one target up here at 0.64 and then we're off. So actually, sorry, I was wrong. So I just ran back to their desk. So yeah, so I was wrong in saying it was 0.5%. Shorter end though, 5-year yields in Germany are still at 0. 2-year yields are still at -0.5. Right, let's just get back to the news one. Okay, bond auctions. Everyone happy about yields and how it all works? Cool. Right, bond auctions. Take my time about this because it's always a tricky one to try and explain. Right, so with a government bond, so we'll use, generally government bonds are the ones that you can actually trade a bit more, just because of the fact that a syndicated auction from a company, you don't know what's actually going to happen with that. If you have a syndicated auction, what can happen is that can then get swapped as well, and that's the situation where a bank will then hedge that auction out. Effectively, by taking on the bonds, so by underwriting the bonds, the bank is long. They then need to sell something equivalent to hedge their risk on the corporate bonds. Generally, there's not another corporate bond that exactly matches, so they will often sell government bonds as an equivalent hedge on their effective long position. Right, so we'll talk about that in a little bit more detail in a sec, but government bonds, how does it work? Effectively, draw a little line here. What you get is anyone participating in the auction puts their bids in for a price and an amount. So say we've got a government bond auction for $5 billion. People will put their bids in for a certain price. The higher the price implies that they're happy to pay a higher yield. Works slightly against the actual current principle that lower prices equal higher yields. So look at this more from the point of view of yield. So they effectively bid on a certain yield. What then happens is the government starts from what's effectively the lowest yield. So actually, yeah, price does make sense. They basically go from the lowest yield and they go, yeah, you can have those, you can have them, you can have them, you can have them, you can have them, and then you get a cut-off price, because at that point they've fulfilled all of their 5 billion of bonds. So these guys don't get them. From that, you then get a fair few different bits of information. First up, easiest thing, bid to cover. Now, what you bid to cover shows you is how a ratio basically of how much was bid for the 5 billion. So if the total of all of these bids equals 10 billion, then your bid to cover equals 2. Simple enough. That's a nice, easy way of viewing a bond auction. You go, right, well, clearly there was twice as many people bidding for this as there was available bonds. Therefore, this is good news. However, you could effectively make it look like an auction is very well bid by bidding really, really low prices and knowing that you're never going to get them down there. So you can skew that a little bit. What is a better indication is whether you get overbidding or underbidding. Now, overbidding and underbidding relate to the price of the bond just before the auction. And the overbidding is how much people are willing to pay over that. That gives you a better indication because you can't skew that by massively underbidding it just to make the bid to cover look better. So the overbidding or underbidding can actually often be a little bit of a better sense of what is going on, and does also explain a little bit of a pattern in markets going into government bond auctions. As a general rule, and this is very general, you will get a market that sells off into the auction, and then once the auction is priced, i.e. once the government has taken all of the bids and reached their cut-off point, you will then get the snap back up. And part of this can often be a case of banks trying to push the price down early so that, yes, they're overbidding for it, but they're still only overbidding at a lower price than it was not long before the auction. So that's a very generalised pattern that you would perhaps look for in a government bond auction, selling into it and then buying back out of it. The other thing that can explain the strength of an auction is the tail on an auction. So what you get, you've got a cut-off price here, which is the point that they have filled their 5 billion of bonds. You're also going to have an average price. Average price, obviously the average price the bonds were paid for. The difference, the tail, is the difference between the average and the cut-off. And the reason this is important is if you've got a very long tail, effectively what that's telling you is that people are almost pushing their luck in how low a price they'll go for it, but also that means that there can't be that many other people really bidding for it. So whilst you could have a high bid to cover because people have bid stupid prices, it still requires a reasonable distance from the average to get to that cut-off point, and so therefore it's showing that really there still isn't actually that big demand for that bond. So in rough sense, one of the worst situations you could get is where you get underbidding and a large tail as well. So that's basically showing you there's not much real demand for the auction. I just think if there's anything else that really needs pointing out. No, I think that is generally it. So everyone happy on all the different elements of it and different bits of information. You'll get all of these things come out. When they say that the auction has been priced, you will usually get the bid to cover. What you will sometimes get is auctions getting uncovered. So what you'll get is perhaps a government only manages to sell 4 billion. You'll see an effective bid to cover of 0.8 because they've only managed to sell 80% of what they intended. This is pretty bad news, basically. It shows that there's a distinct lack of willingness to buy those bonds. On the point of overbidding, if you don't see this situation, this sell-off into it, and you actually see a market that starts to bid up into the auction, and then you get overbidding, that, more so than your bid to cover or anything else, is going to show very, very strong demand. Because not only is it getting bid into the auction, people are still willing to pay higher prices for it. So that's generally very, very good news. One final thing. What will often happen is banks will preempt what they're going to get in the auction. I.e., one of these banks down here, who doesn't get filled, has bid for 2 billion of bonds. So if they get them, they're effectively going to be long. Banks don't want totally unhedged exposure. So what they will do is, because perhaps they think that they're pushing the price getting pushed down, they can get these bonds at lower prices and then hedge them against current prices. What they can do is they will sell current bonds, sell the futures, preemptively expecting to get 2 billion. So effectively they get into the short position before getting the long position. What can then happen is, if you have a very short tail and a lot of overbidding, is they don't get filled, they're now hedged a position that they don't have. And that again is why you can get this bid back up, because they get caught out. So you get the selling into the auction. If you then get overbidding and a small tail, there's a reasonable chance that someone's got trapped and they are then stuck with a position unhedged that they need to get out of. And so they will get out of it. You'll get this drive back higher post that auction. What I'll show you now is a French auction. The reason I use French auction as an example is the French have a consistent time for their auction. They auction bonds on generally the first Thursday of every month. The French will auction a vast chunk of bonds, whereas say the US will auction say some 2 years today, they might auction some 5 years tomorrow, etc, etc, etc. France will usually auction 10s, 30s, 20s, all in one go. So the size of the auction matters. If it's a small bond auction, it doesn't matter that much. You know, if you're getting a 1 billion government bond auction, not such a big deal. Equally, the shorter duration, generally the less impact on the market as well. Certainly against, say, bunds, because it would be a Schatz auction, you don't get the influence on 10-year bonds. So what you want is maturity, height, and size. You get those two things, that's a time where you do want to be watching out for the auction. So France is a really nice example, because they will do 3 or 4 different bonds, and they will do them all in quite big size, because that's their sort of monthly quota of bond issuance to get done out of the way. And I'll play this video. It shows you sort of the price action of what you can expect. You see the selling coming in, you see a consistent sell, but that sell doesn't really push the market down. You then get the buy afterwards. So once the auction is complete, you then get the bid up. So it's effectively a release of that selling. You know, that selling could be that hedging selling, or that attempt to hold the market lower. Once the auction's done, there's no need for that anymore, and that's where you then get the flurry higher. So I'll play this. Okay. Well, that didn't work. Do it on here. Right, I'll try and get that to work in a sec. I'll just answer this question. What's the question? Oh. Where can we see yield charts? Yield charts, best places to look. Either investing.com is very good at it, unless you have access to Reuters. something like that. But investing.com generally has charts of most things you can think of. It also has real-time VIX as well, which a lot of charting packages will charge you extra to have things like VIX and slightly more obscure instruments. Let me see. Try and get this to work. No, it does not want to work. I'll grab the original instead. That will work a little bit better. All right. So here we go. Right. So, as I say, pattern that you're expecting a little bit of a sell into the auction, followed by bidding up coming out of it. Now this should be on double speed, and it does seem right. We'll just do it on Flash Player. I wanted on Windows Media Player because it looked nicer on the PowerPoints and it fit in very nicely, but it doesn't seem to want to do it. So we'll get a Flash Player up instead. Good thing with Flash Player, you can see how it's traded against you can see how you can trade it in the bunds. So, oats down here, bunds over here. You can trade, even if you're not an oat trader, you can trade bunds as a proxy to it. So, watch the oat move, you trade the bunds off it. Which I believe this is Joe trading it. I've got this on slightly quicker time, by the way, so we're moving a fair bit quicker. I think this is double time, just to make it a little bit clearer as to what's going on. So you've had bunds down to the low and starting to tick back up. Oats starting to drift up. It's 9:45. Oat auctions run until 9:50. You then get the price. You get the sort of once all the bids are accepted, you then get the pricing, which comes a little bit later. So usually you get a drop until just before 9:50. You then get buying afterwards, upwards. What you're watching out for down here, you see a lot of selling. You see this volume's building up quite heavily down here. You've got 2 and a bit thousand, nearly 3,000 traded at 02s, 01s. Very little above that. Bunds drifting higher a little bit. And you can see every time we come up to 01s, gets sold, gets reloaded. Skip up, 02s, back to 01s, sold again. 02s goes bid. Now this is where the bunds getting bought. Now you start to tick up to 05, keeps pushing it back. So this is basically where you're getting people selling it into the auction, keep selling it, selling it, selling it, in order to be able to get the bonds that they want. Now you start seeing this tick up. Once you got above 05s, we move away from these 02s down to these lows, start trickling up, and you see the time is now 9:50. So this is a historical pattern to watch out for on an oat auction. It's not a guarantee, of course. You know, you could have an underbidding on the auction and it will go down. Oat starts to trickle higher. Bunds still trading up towards the mid 40s. Remember, bunds have come from mid 30s down here. Oats now up towards 13, 14, and it's still drifting. What you're looking for is at some point, once you hear the pricing, hear that it's been priced, you will often see in the oats a quick flush up. So if you're long in the oats down here, you're waiting. As soon as it prices, you will often see this quick skip up. That's your opportunity to get out. I wouldn't use that as a reason to sit in it or wait and think, yeah, there's more coming here. It's a chance to get out. So we're now up to 9:55. Bunds are still trickling higher, and this is where often you get a slightly preemptive move in the bund, because you kind of know what's coming in the oats. There's no real reason for the bund to get sold, so you can then get your position on the bunds, waiting for the oats to sort of give us a little bit of a push higher. Oats now trading 90s. You see that selling's kind of dissipated a fair bit. Now we start to pick up pace. You see the bunds skip up, and that was with the oats, which unfortunately have not been scrolled up. But the oats jump up to around 28s, somewhere around here, and then pull back quite quick. That's your chance to get out of the bunds. So that's what you're kind of looking for in terms of price action. That you're expecting to see some selling, so quite heavy selling that will hold the market down. In that case, in the oats, it couldn't actually drop us below 2-3 area. It just built the volume up. You see here at the beginning of the video, volume's only 2,000. That got up to about 3k at each price. So you're looking for that sort of selling. Once that relieves, that's when you can start having a go at getting in, looking for that move higher until the auction's priced, and that's often where you will then see that extra little push of volume coming in.
Just ask if you can change the colour of the red to white.
I won't be able to change it retrospectively, and the only difficulty is because a lot of this is filmed off my screen. From a trading point of view, I don't want to change the colour of it, unfortunately. I can have a look into it. I can see if I could change the colours on my trading PC for anything in the future. But anything already recorded is unlikely to be able to do that. So I might have a quick look at it tonight, see if I could change it for the S&P close, or change it going into this afternoon, and we'll see if that might help with anything that we record. I'll record again the closes today, just in case they once again come up with a fair bit of interest, which they may well do. They have done the last couple of days. Incidentally, talking about closes, S&P way back up now, all the way back up to 10 and a bit. So your out, Ollie, was looking like an absolute treat. Yeah, and I'd be pretty frustrated now if I tried to hold on to that and seen it 30 handles on side, and still you feel now probably likely to take a loser on that. And quite something. If it manages to hold those 13s again and come off, then yeah, maybe that's it. Maybe that's going to be the big one to go. Right, everyone happy on bond auctions, on the elements of it that you want to be watching out for? Obviously, with any of these bid covers, overbidding, etc., context is key. Is the context of how it compares to previous auctions, rather than just go, oh yeah, it's 2, that's big. If every auction for the past year has always had a bid to cover of 1.9, then a bid to cover of 2 is not such a big deal. The other thing on bid to cover, and where it's not such a brilliant indicator, is the size of the auction. If it's a smaller auction, it's going to take less people to bid for it to actually cover the auction. Whereas you get a 5 billion auction. 5 billion, by the way, is quite big. Majority of government bond auctions, I'd suggest around about 2 billion. 5's a pretty hefty one. So that's kind of the region that if you see a 5 billion auction, or you see, say, in France's example, they will auction 2 or 3 bonds that are perhaps 2 years each. That's where you know there's likely to be something quite interesting. One last thing on syndicated bonds. If they are corporate bonds and a company comes out with a large syndicated bond, what you can often see is a bit of a move in government bonds. So you might see a little bit of selling pressure in it, but this could come in later on in the day. You may hear that the bond's getting syndicated after that information has already got to the banks. So that strange move you've seen in the bunds in the morning could be a result of that. So it's something to be aware of, but something that's quite difficult to actually pin down, because of the fact that you don't necessarily know when they're going to be auctioned. You also don't know who's got that info before you. So it's a little bit of a shady area ultimately. But the government bond auctions, like I say, do generally follow a similar pattern. So it's a pattern you can at least start looking for. In terms of timing, it's usually from about 10 minutes before the auction up until pricing. So with a German auction, you'd expect selling from about 10:20 down to about 10:30, and then the reversal back the other way. You usually will get the pricing information at about 10:32, 33 kind of period.
Are they daily?
No. German auctions, there'll be a calendar of them, but I don't think they're on a totally regular basis. The US does do a lot more, but the US will do a lot of very short end things, what they're called cash management bills. So they're again much more short-term money market ones. US, you're only really looking out for T-notes and T-bond auctions. They're the two to watch out for. US auctions come at around about 6 o'clock in the evening, if you did want to trade them. Like I say, German auctions pretty much without exception are 10:30 in the morning, French are 9:50, Spanish are 9:40. UK ones are 9:30 as well generally. So they're your sort of timing of auctions. It's something that if you're looking for it and you want to trade it, there is a bit of a trade available, and you can sort of watch out for certain characteristics in that trade. Equally, it's something that could pass you by and you not realise. You just notice that something a little bit different's going on in the market. So worth being aware of, particularly if you are a bond trader, that you don't want to get caught not realising that there's auctions out there. And ultimately, the part of the selling as well comes from the fact that you are getting increased supply. So at the beginning of any week, it is worth looking at what auctions you've got coming out. So if there's perhaps a large amount of supply, and you'll hear the Squawk mention it anyway, but if you've got a week with a large amount of supply in it, what that will usually indicate is that you could see a bit more pressure in bond markets, or that would be your sort of thinking.
I read that the sort of sell-off, equity sell-off last night was because of a lacklustre bond auction in the afternoon. I think that not very much demand. So
yeah, it could make a bit of sense that if people aren't even willing to buy government bonds, it's sort of showing that clearly they're not willing to buy equities at the moment.
Yeah.
If they're not even willing to put the money into government bonds, it's in a sense giving you an idea of the fear within the market that people don't even want to put their money there. They would just want it in cash, because at least with cash it can't go anywhere.
Yeah.
And the only way cash is going down is inflation. With stock prices falling, it's probably not helping inflation very much either. I still see an S&P right up at the highs. DAX is climbing as well. Really hope this isn't a false break of the lows in European equities, and that's the low.
Yeah.
Could be, but we'll see. Like to see the S&P, as I say, back down. Take those lows out. Get the panic on. Make Monday morning very, very exciting. Let's hope. All right, so everyone reasonably happy with bond auctions. Biggest influence on bonds is, of course, monetary policy. It's the most direct influence. It's the clearest thing that is going to influence bonds, and it will vary depending upon what part of the curve you're looking at. So if you're trading shorter end, they're the most influenced by any kind of monetary policy, particularly interest rate policy. governments, like QE, that type of policy can affect much further down the curve, particularly if the central bank actually targets a certain part of the curve. The idea with that is it increases inflation, which we'll come on to in a sec. So, as I say, rate side of monetary policy is more sort of your 2-year, you trade 5-year as well on these. That's where the biggest impact is going to be. Basically, interest rates are cut, high yielding bonds in the secondary market then become much more desirable. So, if you get a bond that's currently yielding 2.5% and interest rates get cut to 2%, you're going to rush to buy that bond because you can still get 2.5% on it. That brings the price straight back up, and it should then equalise with the interest rate, or the interest rate shift. Now, the further out you go, generally the higher the interest rate, because of the fact that you've got to factor in time in terms of interest rates could change over that period of time, and also default risk as well. So even a move in interest rates will affect further down the curve, but to quite a slightly lesser degree, whereas the 2-year and shorter is directly impacted by interest rates, so will have the biggest percentage at least move. You might still see a Schatz only move 10 ticks compared to the Bunds 30, but percentage wise it's going to be a bigger impact on the Schatz. QE, and this is where it does affect more towards the long end. The idea here, central bank comes in, buys the bonds, so by them buying the bonds, rather than trying to influence bond prices via interest rates, they simply just buy them, which reduces the yield, which when you go back to a government bond auction, if they've already bought them and pushed the prices up, yields are lower, therefore their next auction goes off at a much lower yield. So that's most of the premise behind QE. And that's where then the short end becomes slightly less important, and it's more about generally all bonds that are getting bought. They are, some countries are quite specific. Bank of Japan, for example, has yield curve control, what is now terms for part of its QE program, whereby they are trying to maintain yields at different maturities at certain rates. So they will buy more or less of certain maturities, and that way you will see it impacted on different bonds, but otherwise generally it's an overall thing, and perhaps a little bit more skewed towards the longer end, because part of the point of QE is to increase inflation, and inflation is the other big factor in bond prices, but only towards the longer end, because shorter end bonds aren't impacted so much by inflation because they'll mature before the inflation has too much time to actually act on them. Now, the whole reason that inflation matters is because it erodes the value of money. So that's partly, again, why you need a higher yield further down the curve to compensate for that inflation that is generally expected. It's not to say it's a given. You don't always get periods of inflation. But the idea is basically that your future income is worth less, so that 40 received on a 4% coupon will buy less. What this effectively does is lower the yield on the bond. So as that yield falls on the bond, makes them less attractive, people are slightly less willing to buy them, so increases inflation, you see longer end bonds falling until you get a yield that compensates for that higher level of inflation. Conversely, no inflation, people will buy the bonds because they're happy to take reasonably low yield because you're not getting that inflation impact on it. So inflation does start to swing the longer end a little bit more than monetary policy and interest rates. All make sense? The other big thing with any bonds, creditworthiness, and not really seen this in the last couple of years, really. It was more, I think, in Europe, say 5 years ago, where credit ratings on bonds really mattered. So you'd have the rating agencies will give a rating for each government's credit. So, for example, UK is generally AAA again now. It did get dropped to AA. Germany's AAA, US is pretty much AAA. Going down all the way to C and then D for a default, which Greece nearly hit a little while ago. And what you then get as a result of this is a lack of desire to own bonds of less creditworthy companies, all countries even, all pension funds and mutual funds, things like that. And this is where you can end up with this creditworthiness getting forced the wrong way. They will often have rules around what credit rating bonds that they own can have. So if you can only own bonds with a AAA down to A rating, any country that falls out of that, you then have to sell that portfolio, which then pushes the price of their bonds down, pushes their yields up, and effectively then could make them less creditworthy, which perpetuates the issue. So you do often have these situations where you can get this trigger which will actually cause a mass selling of bonds just because certain criteria or certain rules have been triggered for pension funds, mutual funds, things like that. Nice example. Well, as I've just said, you need a high yield if you're less credit worthy. I'm not going to lend to you if I don't believe that you're going to pay me back. But if you say I'll pay you 10% interest as well, I might be a little bit more inclined to lend money to you. So they have to compensate for that credit risk by offering better yields. And what this creates is a nice, really easy way of tracking countries' creditworthiness by using a credit spread. Basically, you take a safe country, i.e. Germany, and compare the yields to another country, which, you know, Spain, somewhat less creditworthy. And that credit spread effectively gives you a risk premium. So you are X number of times more at risk by investing in Spain over certain other countries. Obviously, these aren't exact yields. What we counterintuitively saw during the European debt crisis was actually these credit spreads coming in very, very narrow, and also to a point where with the ECB's QE program as well, you actually had yields on countries like Spain, countries like Italy, etc., actually dropping below yields on US treasuries. So from a credit perspective, or at least basing it on yields, you're actually basically saying that countries like Portugal, Ireland, Italy, Spain were more creditworthy than the US at the time. Slightly odd point of view, particularly as a year earlier their yields were 7, 8, 9%. I think at some points Portugal got up to about 12% yield and then dropped right the way back down, right the way below treasury yields. So not always the best measure of creditworthiness, but it's a good sort of gauge of risk, and it's a good gauge when you do see these situations where that becomes a focus thing. And as with everything, it is all about what becomes in focus. Get that situation, and the spreads moving within the day actually can cause quite a big impact on equity markets and on bond markets. One final thing on credit, and this is why when the US got downgraded, you actually saw US yields fall, is because in any time of uncertainty, of worry, you will get a flight to quality, and people will go and buy generally what's perceived as safest countries, i.e. the US, Japan, Germany, UK. They're probably the top 4 in terms of perceived safety, with US being the number 1. So any major issues worldwide, globally, you would expect to see treasuries getting bought, which is why this sell-off at the moment is quite an odd one, because you're getting them both coming off together. So you're not getting this rush into treasuries away from equities or away from any other risk assets. And that, I think, is what's really spooking people. Like we've said earlier on today, or yesterday, about it being a bit of a credit thing. I do think there's an element to it. Certainly when you talk about that auction failing or being received very badly, sort of showing that there isn't that flight to quality at the moment. So yeah, it's now a case of, will it continue together? I think that could be a telling thing. If we start seeing, for example, next week, equities continue lower and then bonds start rising again, you can see what's going on there, and you get that switch. Whereas if the money comes out of both again and they both keep falling, that's where I think people will start to get more and more worried that no one really knows where to put their money. And in that instance, the next place for quality is going to be gold, I would think. Maybe cryptocurrencies. Very speculative, that. I don't think you're going to get large institutions, hedge funds rushing out of, very well-known, well-established companies, running out away from government debt and going buying Bitcoin. Could happen. I doubt it though. Surely you would be more inclined to buy gold or just bank deposits. Keep your money very, very safe. You might see it more in short end bonds, that you'll get the move towards much shorter end as well, to try and stay away from the risk of anything longer term, or this turning into any longer term issues. All right, yield curves. Everyone happy, or anyone know about yield curves and what they will often imply?
With time, with years, yeah, it's hard to say.
Pretty much, yeah. That's what you would expect a general yield curve to look like. That you get a lower yield at the shorter end, yields rise towards the longer end. This part of the curve, that's your interest rate sensitive part, and then the rest is inflation and credit, effectively. So that's a general expectation of a curve. What's been worrying people recently is, and something that is deemed often a very good indicator of a recession, is an inverted yield curve that goes like that. Reason that this is indicative of a recession is it's showing basically that you've got no inflation later on, and also that there is fear or an unwillingness to lend in the short end. So people are worried that they won't actually get their money back in an inverted yield curve situation. This is quite a big factor though, the lack of inflation, lack of growth going forward, shows limited prospect in the economy going forward. And also an expectation, therefore, that you are likely to get lower interest rates going forward as a result of a recession. So that's something that people have been worried about, the yield curve going inverted, or at least flattening. We'll talk about yields flattening and steepening in a minute. I will run you through with a little bit of thought as to what happens in each situation of where you get different types of flattening and steepening in the curve. So the way you get that is basically to do with which bonds are getting bought and sold in relation to others. So let's go and have a quick look at that. Right. you get 4 types of yield curve move. You either get a bear, flattening or steepening. You then also get a bull, flattening or steepening. Difference between the two is anything bear is selling of the bonds. Anything bull is buying of the bonds. So in a bear steepening situation, what you end up with, what I'll do is we'll have 2-year and 10-year, just to indicate long and short end. In a bear steepening situation, both bonds are getting sold, but because you're getting a yield curve that is effectively going up like that, 10 years are getting sold harder than 2 years. So in that situation, you know that you want to be looking more to be trading 10 years from the short side. And if you're going to see any bounces, the bounce is going to be a lot more limited in a 10-year compared to a 2-year. So if you're looking at all the bonds along the curve, you perhaps don't want to get yourself too caught up in using any kind of 2-year move as an indication for the 10-year, unless it's a move lower. Conversely, if you get a bear flattening situation, you're seeing yields drop down towards flat. So what you're getting is yields are rising, but they're rising more in the short end than the long end. So you're seeing more selling in 2 years compared to 10. So that's the situation you're getting, effectively, that the curve has gone from that to that. It's effectively what you're getting. Why you get these kind of things? This is more likely to be some kind of inflation related move. So if all of a sudden inflation expectations are rising, if you're getting big inflation numbers, that's likely to be the cause of this type of move. Converse, the other way around, or if you're getting some kind of more interest rate type move. Now with a bull steepening, what you are getting is bigger buying in 2 years compared to smaller buying in 10 years. Basically, the reason being the the yield curve's rising like that, but it's rising by virtue of 10-year. So effectively, it's still going. Yields are dropping, but they're dropping less in the 10-year end of the curve. So you actually see a shift down in yields, but you see a relatively larger shift down in the 2-year yields. Make sense? And then a bull flattening situation, you get the other, whereby you get a bigger move in the 2-year. So you then get a slightly steeper curve, which goes flatter because the 10 years have been bought that much stronger. So the 10-year end of the curve is the end that moves down. 2-year doesn't really move too much. So what you can use all of these things with is, generally, if you start seeing this situation, it's not going to be a one-day thing. It will last a little while. And so for that little bit of time, you can then start watching a little bit more of a certain part of the curve. Often, some of the better moves or more clear moves in terms of if you are watching each of the different components is when you get either bear steepening or bull flattening, because you're getting the long end leading the move. You're getting the long end with the more excessive moves. So you can watch a 30-year bond, 30 years called Buxel, or in the US a T-bond. Can give a little bit of an easier read, whereas if you're watching the 2-year, it moves a lot less, the moves are a lot more subtle, a lot slower, and so therefore it makes judging how much impact that's going to have on the 10-year a little bit more difficult. So ideal situations, you want either some bear steepening or bull flattening. That's, they're the prime situations that you're looking for. And then you can then start watching the 30-year, which I think if you're going to watch any other bond and trade off it, the 30 is probably the best when it's actually moving the 10-year. If it's not, and that's where you have to realise which situation you're in, if it's not doing that, then it becomes a little bit irrelevant and you can end up getting stuck concentrating on what the 30 year is doing when actually there's no reason at all to be doing that. So that's your bear and bull steepening, flattening concept that takes a little while to actually get your head around, but certainly in the moment you sort of see things going on and you go, what is exactly going on here? You sort of work it out. It's more sort of intuitive that you can sense what's going on anyway before then working out, oh yeah, this must be bull flattening or whatever. Right, I've got some yield curves up here and always quite a nice little quiz. There's 4 countries in here: US, UK, Germany and Italy. Which curve's which?
What are the yields? 3, that's 3, then 1.
Italy is blue.
3.5. This is at the longest end of the curve. 2.8, 1.7, 1.3.
And the countries?
Italy.
Countries are Italy, UK, Germany and US.
Italy.
US is
US.
2.8. US
Sorry?
US is 2.8. No?
This isn't brand new, which is purposeful. I'm not necessarily saying you're wrong, but I'm just saying.
This is 10 year?
Huh?
This is 10 year?
Well, it's the whole yield curve,
Oh,
so
this
this goes from 1 month's up to 50-year bonds.
And the, okay, so this kind of the break in the lines, this is was the 10 year?
Sorry, where's the 10-year? Whoops.
So yellow
But
is
US is
West,
around 2%.
green UK, and then purple Germany.
So you're going
Italy blue,
US,
yeah. UK green.
UK, and which way round?
Germany at the bottom.
And Italy is blue, yeah, Italy's blue.
Nice one.
I'd swap UK and US.
Yeah?
Will you-
What's the reasoning for swapping UK and US?
UK's a high risk right now. I reckon you're probably safer bet in US Treasuries than UK, so there'd be a better risk premium on the UK one than US.
Ah, interesting thought. The original one was right. One of the biggest factors is, and this is where that sort of risk premium element is quite difficult, is current interest rates. That
Of course.
US has had higher interest rates for the last few years than all the other countries. So US starts at the highest point and then has gone out, and you can see a US curve relatively flat, particularly compared to, say, a German curve. Germany's lowest, particularly down towards the short end because of the ECB policy and the fact that they've dropped interest rates below 0. So you're actually seeing, there's the 0 line. So that's 0 in terms of rates. You actually get everything in Germany that is less than 7 years is yielding below 0%. Like I say, I purposely didn't put up the current one because that might be a little bit too easy. So yeah, everything in Germany, and this is the clue to the Italy one, the fact that you've got a lot of Italian bonds out to 3 years, they're still all yielding negative, and this is because of the ECB bond buying and pushing them all lower. So that was your clue there. Another little clue as to which was which is knowing what maturities they go out to. UK and Italy do a 50-year bond. Germany and the US don't. And that's something to keep, as you know, he's talked about sort of like scenarios and possible things that could happen. US has talked about it for a little while, particularly since Trump's come in, of having a 50-year bond or potentially even a 100-year bond to make the most of the current low interest rates. It's not something that's been done yet, but the theory is if they do bring in this much longer duration bond, you're going to get very quick selling of treasuries because of that extra duration that gets put into the curve, extra selling of bonds. So you should then see pretty big selling of US treasuries.
Commercial banks are floating rates to hedge when they take part in the auction of these, right?
Part of that, and also that there'll just be more supply coming into the market. So anything that's giving greater supply is likely to cause a drop in yields. And yeah, also the fact that they'll sell the bonds to push yields higher as well, because the US is basically taking on much longer risk as well. So yeah, there's an outlier to be watching out for. So I just looked at it. S&P, lovely. Tested up again just over those 13, 16 area and can't do it. That's pretty telling. I think could well, I keep saying it could well do it, and I think I'm kind of looking for reasons for it. But what I also like from a profile point of view is on the open, we've tested into yesterday's value area and then dropped straight back through the open. That's a pretty decent sign in my opinion. I think at least we've got to get down towards 90 to try and test that close. And the longer time we spend without getting into yesterday's value area, the more and more likely it becomes that we're going to go lower. So what would be good to see in terms of if you're looking for a move lower is to spend a bit of time down here and then have the push down.
So below the VPOC, or just below?
Well, yeah, VPOC from yesterday is way up 30s. So yeah, I think you've got these single prints here, so I think this area may get traded out a little bit, so we might spend some time here, despite the fact we spent a lot of the overnight session there. And then, yeah, I think if you get through this close, that could be your signal to at least have a go at those lows. So, yeah, interesting start for the S&P so far. I think perhaps another choppy session coming up. Right, everyone happy with yield curves? Yeah, recently we'd really seen the US 2 years getting bought. They got bought from about 6 months ago. Bring you in a chart of that. US 2 years got massively bought up. Get rid of that one.
The biggest bond market.
Sorry?
I was asking, is Italy the biggest bond market? I believe in Italy is the biggest bond market.
Yes, it's if it's not, it's very close. Yeah, Italy has a huge bond market compared to what you would perhaps ordinarily expect. And this is where we were getting that yield curve flattening from the US. So what you've got is a 10-year, a 5-year and a 2-year. And from sort of September, October last year, the rally in the 2-year was huge, like pretty much non-stop rally in the 2-year. 10-year, nowhere near as much.
This is yield, right?
Yeah. Oh, that's a weekly. If I put these onto a weekly, it might show up a little bit clearer. But yeah, they're the weekly moves. And so this is coming from, say, Q3 2016. And you see this break up here in the T-notes, you compare the break points, the move in the 2 year is much, much higher. And that's where you've seen that flattening of late in the US. And then you've had this massive drop off in the 2 year yields. And in, well, all of them this week. I think that 2 year one's probably a little bit more pronounced with this fall. And interestingly, it's the 2 year and the 5 year just about, they've not managed to get back up above the opens, whereas the 10 year is trading just above the open of this week. So that's kind of showing there is a little bit more strength back in the 10 year now compared to those 2 years. Perhaps this is where we're now going to see that steepening come back in. And if it's a sell off, it's going to be a bear steepening move. So you'll get greater selling in the 10 year than you will in the 2 year, which is perhaps the kind of thing you want to see. The only thing I would say on a weekly point of view, that if it does close there is a rather bearish candle, and you'd be looking at that thinking this is going to go down from here. So we shall see. We've only got, what, 6 hours to go, and then we'll find out if we've got a very bearish looking week for the for US yields. And if we do, then you could well see further selling of T-notes going into next week, which will be nice to see. All right. Let's move one last chart, I believe. This is Greek government debt. This is back in April 2011. Greek government debt yields on a 2 year bond, you could get 25% yield on a 2 year bond. Anyone know why you get this really odd semi-inverted yield curve?
QE.
No, QE hadn't come in at the time. Main reason for it was no one believed that Greece would get beyond 2 years without defaulting. So the big selling was in 2 years because there was hope that even if you owned any of these bonds, you might eventually get made good on it if they default on the shorter end bonds and then don't default on the rest. That's part of it. Also the fact that there wasn't the panic to sell these bonds in quite the same way, whereas the panic to get out of 2 year short end bonds for Greece was pretty massive. So yeah, you ended up with this very, very obscure looking yield curve. That's probably the greatest sign of panic you'll get. You know, if you get that kind of thing in another country, that is a really big sign that, you know, you're getting some good panic on. So we'll look out for anything like that in the future, but at the minute we're not seeing it. Maybe US 2 year keeps going the way it goes and we'll get that kind of situation for the US, and that will be quite something. Then I would expect these moves to continue for 6 months maybe, and that's when you will start getting interest rate cuts, all sorts of things going on to try and bring this bit down and this bit back up. You get a more normal looking yield curve. Everyone happy on bonds, on yields, on things you want to be looking out for in these markets, government bond auctions in particular, and then beyond that, in terms of when you're trading, inflation numbers, you want to trade in bonds, you want to trade in currencies, monetary policy generally as well, you want to be trading in bond markets. The one thing I would say on monetary policy, stimulative monetary policy often shows up best or is better traded in equity markets, just because equities often have what people who trade bond markets would like to say is a lot more dumb money in it, and equity markets have a little bit more of a that's good news, buy it attitude, whereas bond markets will go, yeah, that's good news, but the curve says this, and so this part of the curve shouldn't keep doing this. So you have a lot more sort of curve influence on bond markets over sort of stimulative situations compared to equities, which good news is good news. Up they go. You know, if yields are dropping, if interest rates are dropping, company borrowing is cheaper, easier to finance things, so it's generally better news. So just one sort of little caveat there on government bond yields. So yeah, that's it for yields for bonds. Give us a little chance to have another go at this S&P for the rest of the afternoon. I think it's more important to get you guys trading as much as possible at the minute, because this is the kind of stuff that you won't see all the time. And for a lot of people, probably never seen it for a lot of people starting in recent years. So yeah, if you can get used to something like this, it's a good situation to be in. It won't shock you when it comes back, whereas I think a lot of people who got very used to the much quieter periods don't know what to do when you get these bizarre and very, very fast total change in characteristics of markets. So yeah, let's have a go at trading this. I'll as always try and put up any sort of thoughts on the chat, and our stock can chat anyway. So yeah, guys online, we'll catch up with you next week. Next week we're going to get more into technical stuff, so there's going to be a little bit more sort of things for you guys to be specifically looking at, things for you guys to do, a little bit more sort of information coming out there, and sort of trade ideas, trade types to put on, expectations of trades, how to manage trades, a little bit more like that. So that's the plan for next week. Technicals, predominantly candlesticks and indicators, and then we'll move on to price action and market profile. Right, until next week, guys online, we will see you then. Have a good evening.